We're very particular about the culture of the business we acquire. They don't have to be perfect businesses, but they have to have a strong culture around taking care of employees and taking care of customers. If you're doing that well, even if you're not pricing great, even if you're not doing a great job in your call center with leads, if you have that cultural foundation, that strength, you can fix those issues.
Welcome to The Boost, a podcast for home service contractors. We explore leaders and innovators in home services, their personal journeys, thoughts, and experiences with growth, marketing, and succession. We cover the good, the bad, the ugly, and its ultimate impact. Hello, everybody. Thanks for being here for another episode of The Boost. I'm Zach Wilson, Chief Marketing Officer of Local. Today, we have John Cerasuolo, CEO of Leap Partners. John, welcome.
Zach, nice to see you, and great to have a chance to chat and catch up on things.
Let's get into it. We're going to talk about Leap Partners and the state of private equity and the path to riches for all these contractors. I'm just kidding. Tell us a little bit about Leap, what you guys do, what you're looking for, who your prospective partner, if you will, is.
Sure. So to start with, just by way of introduction, I do not have a deep background in HVAC and plumbing industry. So I've got a lot of experience in doing roll-ups and buying small companies and putting them together and building bigger businesses. This is actually my third. So I've done one in telecom services, one in home security, and now Leap Partners, where in HVAC and plumbing. So I come at this from the perspective of building a culture, building an organization that integrates many small businesses to build, in our case, is a regional company. We're a Southeast regionally focused business. So we launched Leap Partners, myself and the team that was with me in the security industry, the last effort that we had. So I brought over a team that had a lot of experience in executing on the vision that we'll be talking a little bit about. We launched a little over 2 years ago. So March of 22 was our first acquisition. We've done 18 acquisitions so far. So we're at a pretty steady pace of closing deals. Our model is a little bit different than the many companies that are out trying to do what we're doing. We are private equity backed. We are partnered with a wonderful group of folks at a company called Concentric Equity Partners. They're in Chicago. And they're what you will hear referred to as a family desk, which is maybe kind of like a subset of the private equity world. Family desk tends to be a little bit more patient, maybe has a little bit of a different approach than a traditional private equity company that rotates in and out of investments on a really set schedule. They have a lot more flexibility. And it's essentially a wealthy family that is deploying capital that they have. So we've got a great partner, super people, and we really look at them as part of the team that's executing on our vision.
This is kind of an interesting nuance that probably a lot of people aren't aware of. So Concentric Equity Partners is a family office, correct? Most people probably don't know this. Family office has basically different fundamentals behind the scenes in terms of where the money comes from, some of the disclosures and regulatory of the SEC and so on and so forth. But the big thing is that John touched on is when you hear the word family office, for those that haven't heard it and aren't familiar with it, it is in fact a family that has made a considerable amount of money in some industry, and then they take that money that they've earned and reinvest their own money through this vehicle, the family office, into other opportunities. And so there's gazillion examples of these. If you look at the Forbes 100, for example, John, you can probably test this. Every single one of those people has a family office. Bill Gates, Warren Buffett, everybody on that list. I can't think of every single name. Those are the big ones. A lot of these family offices have strategies behind the scenes. Some will literally only invest in real estate. Some might invest in sports. Some might invest in, I have a really good friend who works for a family office, and their vehicle is it's naked property and restaurants, of all the things. And it all goes back to this guy's childhood where he grew up in England working at his dad's bar. So he has this like deep rooted passion in the restaurant industry, and they have a huge portfolio of restaurants, which most investors would not want to touch with a 20-foot pole. Restaurants are, generally speaking, terrible businesses, but it's just a passion of his.
Well said. I think from my perspective, one of the significant differences between a family desk and a more traditional private equity firm is related to how they raise money. So generally, the traditional private equity firm will raise a fund. They'll get a bunch of wealthy investors to write checks. They'll raise a fund of X million, billion dollars, whatever, and then they'll deploy that. And they have to return that capital to those limited partners at some point. What's good about certainly our situation, I think more so with Family Desk, is they tend to be much more flexible on the timing and they're less subject to having to make decisions based on the ticking of a clock.
Yeah, yeah. It's just like the platforms in private equity too, in terms of how they decide. I know for a fact the example that I just gave and a few others I know locally here in Cincinnati, Ohio, they don't take anyone's money. They literally don't let anybody in. It literally just complicates things for them and it's not worth the diversification and the risk. And so they don't want people, they don't want any other money except for their own in the office and spreading it around, which is probably a good segue back to some of the platform and the private equity models of how equity is taken on and how it's distributed, whether platform level, operating level, et cetera. So do you want to speak to that for you guys and the pros and cons of what you do?
Let me try to circle back a little bit more just in general as we're talking about relationships with private equity firms. So when we started thinking about pulling this business together, first thing we did was pull together a business plan. So we did some research. We wanted to do something in home services. That's where our experience was. We looked at lots of industries. We talked to a lot of folks that had background in everything from roofing to landscaping to pest control to HVAC and plumbing. And based on what we learned, we decided HVAC and plumbing was the best market that suited our skill set and our business model. And that was most in favor with investors and kind of where the dynamics were very positive. So once we had that business plan built, then it was a matter of going out and finding investors. We talked to lots of potential investors. We thought about self-financing it and starting it up kind of on our own. And we obviously landed on a partnership with Concentric. And there's a lot of reasons why. I mean, I mentioned one of the reasons about the timing and the clock ticking on an exit and having some more flexibility. That was important. But there's lots of other important reasons to think about when you're starting something like this, what kind of investor to take on. So what really comes down to, obviously, the structure of the deal is important. How much money an investor's putting in, how much equity in the business they're going to get for the investment and cash that they're putting into the business, their ability to sustain kind of investing as the business is growing. From my perspective, what's really important is picking a partner that is aligned with strategy and the values of the folks running the business. So we wanted a partner that believed in what we were doing, that understood the trades, because a lot of investors don't understand the trades, and there's obviously some really different dynamics in industries like ours. And a partner that was going to be able to offer something to us other than cash. Cash is important, but it's nice to have a partner who's able to help in lots of other ways, particularly for us because we were new to this space, and Concentric and other investors have varying amounts of kind of experience and ability to support. We wanted a partner that really was going to be able to lean in and play an active role in helping us determine the strategy for the business and the path, and had lots of good contact. And those kind of things are really just as important as the mechanics of the deal. And I think a lot of times when someone's selling a business, the first thing that you think about, what am I getting for it? What's the consideration? How much cash? How's the structure of the deal? Of course, that is really, really important, but you can't be single-minded in that respect. You have to think about, who are you turning your business over? Who are you partnering with if you're going to stay? Do your interests align with theirs? Are they going to take care of your employees the way that you want them to? Are they going to honor the brand and the name and the business that you built? I think whenever you enter into some kind of a partnership like that, you have to pay attention to the details and then the structure of a deal, but you really need to feel comfortable with the person on the other end of the table.
Yeah, yeah, yeah. And just to be clear, you're speaking of both sides of it. You're speaking of it from your partnership specifically with Concentric, and then of course, whoever your acquiree, the partnership with you. And those things are obviously very important. So talking specifically about your target audience and your target seller, if you will. We had discussed before, it was you're kind of going for the 500,000 to 1.5 million EBITDA is kind of your target. And generally speaking, because obviously there's fluctuation in that, I think for people that aren't ready to sell and don't have their I's dotted and T's crossed per se, that calculation's a little bit tougher. So then for example, top line revenue. So what does that translate to, just generally speaking, in terms of who you're looking for from a top line revenue standpoint?
So you characterize that correctly. Our model, our strategy is to find businesses that I would say our sweet spot is a 500,000 to 1.5 million. Our range is really from a couple 100,000 in some cases where there's a small fold-in opportunity up to 2 million plus in EBITDA. So the vast majority of our deals are in that 500,000 to 1.5 million range. So from a revenue standpoint, of course, it varies. The typical EBITDA percentage will be anywhere from high single digits to maybe in the best of businesses up to 20%, something like that. So $1 million business might be 5 million to 10 million in revenue, something along those lines.
Right. Operating at 20% margins. The general computation is, if you're looking at computation backed in for EBITDA, is would you characterize in-home services based on your 18 deals? What would you say is the very healthy to moderate health to low end health in terms of the deals that are people are looking to sell in terms of net profit? Let's start with what's unhealthy in your mind, or be a really low trade multiple from a net profit perspective.
It varies, as you can imagine. A lot might be just a couple of $1 million in revenue. And it's really hard at that size to have a high net profit percentage. You could be on the other end of that too. Some businesses have too high of a net profit percentage, and it just means the businesses are not potentially not being invested in, or the owner is just taking on 3 jobs and is doing really well. And in some cases, really good, talented people run these businesses that just carry a massive load, but it's likely not sustainable in the future. So anything in the single digits is something you have to take a look at. A lot of it will depend on the size of the business, the kind of work they're doing, the market that they're in. Typically at 10 to 20% is kind of the healthy range.
Is there a place where someone approaches you per se? And I was having a conversation with someone just a couple days ago, and he was talking about a business that they were looking to acquire, and they're like, they're 5% net profit. And again, this was in their eyes, it was like, that's just not worth anything, right? This was a different category, not home services, just to clarify that. But that said, in home services, is there a net profit for any size business that you deal with? You got to work on your margins before this is going to make any sense.
This is interesting. It's generally not the profit margin that's going to be the determinant of pursuit. A couple of thoughts on that. In some cases, a business that has a low profit margin, it can be something that is relatively easy to fix. In many cases, what we find, companies with really low profit margins are not pricing their services. And it's an easy trap to fall into, especially in the last few years, as input costs have gone up. And companies that haven't been fairly aggressive at raising prices to match the increase in pricing of their inputs find themselves in that situation where their margins are shrinking. So in some cases, it doesn't scare us away if the margins are low, because we have a good sense of how we can help to fix it. Some of it also depends on business might not be operating very well and could use some help. Maybe it's technology to support field operations. Maybe it's training. And to the degree that the buyer thinks they can offer that kind of help to a business, they'd be more willing to pursue someone with a decent top line, even if the bottom line isn't very strong, because they're betting on their own ability to help that business improve in the near term.
I think that's well said. And I think the more interesting part of it too is that, going back to the earlier part, is that if your net profits look too rosy per se, that it might be a bad signal, because the takeaway for me was that you're overloaded somewhere. You need to staff up and get some more resources, or you're not investing properly. I was talking to somebody that just got a deal closed and they tipped into double digits, a multiplier again, which I haven't heard in a while for anybody. I don't know about you guys, but in terms of what you're paying, the market is the market. You got to do what you got to do. His point was the business that was being sold and purchased in this case had done pretty much the opposite of what we're talking about, an extraordinary job staffing up and creating these management layers and these support layers, where the owner of the business, taking them out of the business, was going to have zero impact on the business. And I think Tommy at A1 just incessantly, and is probably the greatest voice to represent how important this is in diversifying and bringing management up through the ranks and basically divesting your skill set from the business and the dependency of your skills on the business. And that's how you do it. And just to close this out, if you're not doing that, it can have the complete opposite. You might think you're like, oh, I'm saving money. I've got all this extra money, this cash flow or whatever. But if you're looking to sell based on what you've just disclosed, it can be a big hindrance to your ability to sell and creating more value, because the owner, instead of doing more or less 0 jobs, which I think is the ideal, they're doing 4 jobs. And you're like, well, that guy gets hit by the bus, the business is screwed.
You raise an interesting point that I think is worth chatting about a little bit. So you also have the opposite case where, as you mentioned, an owner sees a way to increase the value of the business by building a strong staff so that the business isn't dependent on it. No question, that's a significant value. But you'll often find businesses that staff up for growth, right? So that build an infrastructure, build a management team that maybe can support a business that's twice as big as the business is today. And that certainly is a viable strategy to run the business, but you probably don't want to think about selling the business shortly after doing that, because you've imposed the cost on the business, but you haven't yielded the benefits yet, right? So if you're going to take that step, not just invest in the talent so that you have somebody that can take the lead role, but really invest in the organization so that they can handle significant growth, you're going to want to do that only if you have a runway ahead of you where you're going to be with that business long enough to have 2 or 3 years of demonstrating that kind of growth so that you can get the value when you sell. Otherwise, you've negatively affected your profits and haven't yet demonstrated that that investment is going to yield anything.
This is one of the damned if you do, damned if you don't situations. Basically, got to execute perfectly. That's what I'm hearing, which is definitely a common factor with a lot of these things. And maybe you can tell the story. When was it? It was sometime last year with Paradise Home Services, and that was kind of serendipitous, right? Like, they weren't Paradise Home Services, of course. Justin and Kristen Deasy down in the Panhandle of Florida, and they started it from nothing. And they were trying to build it up. The goal was to build it and sell it. And you guys ran into each other, or somehow it came up that you wanted to buy it or whatever. And it kind of happened, which is just serendipity at its finest, I think.
This is illustrative of our general approach and our model and our strategy. And yeah, Justin and Chris had a tremendous business, 2 really talented guys. And we came across them. I'm not even sure how we first came across them, but we love what they were doing. So what's a little bit different about our model is we buy businesses where the owners have an enthusiasm for staying with us and continuing to run their businesses. So we don't change the brand of the businesses. We really don't do much in the way of changing the way the businesses are run, other than the kind of the support structure behind these companies, with the idea that we're going to offload the owners from the back office kind of stuff that most owners hate to do: payroll, taxes, benefits, insurance, recruiting, marketing, fleet management, all those things that just kind of distract you from taking care of your employees and your customers. So our target is an owner who is happy to get rid of those tasks, but loves running their business and has the opportunity with us to, kind of take some of their chips off the table, but still stay invested, because they'll roll some of the proceeds of the sale into shares and lead partners. So they basically are still an owner of a bigger company. We have in all of our locations folks like Justin and Chris from Paradise that continue to run their businesses and have the opportunity to benefit from being part of a real great culture and a big organization with lots of support and help around. So Justin and Chris down at Paradise, it appealed to them, I think, in the same way it generally appeals to the rest of the really talented owners that have joined our team, that, they're not ready to step off the ride yet. They're enjoying what they're doing, but our structure just kind of changes some of the dynamics a little bit. They get a little bit of their life back. They're no longer have their entire net worth in one entity. They can take vacations, unlike before a deal where it's often hard for an owner to get any time away just because of the demands of running the business on your own and being 100% responsible for it. So it de-risks them a little bit, allows them to maybe diversify their portfolio a little bit, but still be an owner, still stay invested, still have a business to run, and have a team to be a part of. And that whole kind of dynamic, I think really appealed to our friends at Paradise. We've got a great organization, a super team.
And just to circle back to something we talked about at the beginning in terms of the investment divestment model that most of your partners choose, is it variable or is it pretty much of the 18, everybody chooses the same thing in terms of taking all their chips off the table, leaving some of their chips on the table, rolling up their chips, et cetera?
Everybody is an investor, but they do have some flexibility in the structure. It's generally 10 to 15%, something in that range. We've had some that were interested in more and they didn't have the need for the cash. They liked the idea of staying invested and believed in what we're doing. As we're doing more acquisitions, we need to raise more equity. So when you do an equity raise, generally what happens is the private equity partner, the financial partner, writes a check and kind of reloads so that you can go out and continue doing deals. Again, our partner's a great partner. One of the things they do is they open that opportunity up to the management team. So the last time we did an equity raise, we had a number of these former owners that were now our partners that basically wrote another check to invest and get even more shares in Lead Partners, which was a huge vote of confidence, I think, in what we're doing. So I think the answer to your question is the needs of our partners vary and we're flexible to meet those needs, but everybody is to some degree has a meaningful number of shares as an owner in Lead Partners.
And just to clarify, I think what you're saying is that's at the platform level, not the operational level, right? As you said, rolls up, right?
That's correct. We're one legal entity.
I think that's interesting because they're different places, different folks, different strokes. Some limit it to the entity and the operational level, and some allow you to roll up, and some don't want you out as soon as it closes. They don't want anything to do with you. So it just varies, and it's a philosophy thing. But I mean, this is probably a rhetorical question, but given the model and it's one entity and all rolling up to Leap, do you believe or feel that by doing that, the operators and staying on operate is advantageous to the team and the business and keeping some of the culture and personnel? And so you're not creating too much disruption where the philosophy is rooted?
I think what we really like is the idea that we are one united team working towards one common goal. Because partly just because they're good guys and talented leaders, they want to work together. But the fact that we're all invested at the level of Leap Partners, the result is our team shares a lot of information, very open to helping each other out. You think about it, when you're running a business, one business, you can be doing a lot of things right, but there's a lot of things that somebody else you could learn from and they're doing better than you.
God, yeah. Yeah. I mean, everybody everywhere should be saying that because if you're not, then you're probably in your own way, right?
Yeah, you're kidding yourself. So all of our companies have something to teach each other and something to learn from each other. And they really enjoy the opportunity 3 times a year. We meet, we spend a couple of days together. We're constantly in communication in teams to try to share best practices. I mean, think about pricing, just as one example, right? You could be really smart when it comes to pricing, but a lot of us have assumptions and ideas about what's the correct way to price and don't really have the opportunity to test it out. Well, we've got 18 businesses that we can now sit down and say, how are you pricing this? How are you pricing this? We don't have standardized pricing across the whole organization. The local branches and leadership manages that. But now they have a chance to say, wow, so that's how you're pricing it. Or compensation and reward structure. Oh, that's really interesting. That's how you've chosen to reward your field employees, or that's how you've chosen to set up that incentive structure. And so all of those things, the result of it just kind of feeds on itself. We just think that the idea that we're all shareholders in one company facilitates and support that even more so than it might be otherwise.
I agree. And so you've got all hands on deck and everybody's working towards the same goal. Another great segue. I feel like I've used that word 500 times today, but what is the goal? Where is Leap trying to go? You mentioned the telecom roll ups and where you'd gone before. Explain to the listeners, what does that actually mean? We do have some listeners that aren't as savvy with all the financial terms, but define what a roll up is.
The idea of a roll up is an entity is acquiring a number of small businesses to combine them in some way to become a bigger entity. It can have a negative connotation in some cases. the idea that you're rolling up a bunch of small things to make a big thing. That's conceptually, that's what it is. And there's lots of different ways that folks do it. As you mentioned, there's some folks that do it and they want the owner to exit the day that close the deal because they're going to combine things in a way the owner would not really have a role or be a part of it. They want to standardize things or something. Those strategies make sense and work in some cases. Our path is different, obviously. So roll up just as indicates it's taking a number of small entities and building something bigger. And the idea of that is bigger entities get a higher valuation. So if you have $10 million businesses that you were selling individually and you sold all 10 of them for a market price, and then you took those 10 and really combined them and integrated and made them a $10 million business, that $10 million business is going to be worth more than 10 individual $1 million businesses.
Let's just say for math's sake, right? Maybe it's an average thing, but let's just say in your example, you have 10 $1 million businesses, pull them together. They're now a $10 million business. Why is that more valuable? Because especially in this space, I think it's really interesting. Whereas I don't know what happened on the telco side, but if you take the optometrist roll up or the vet roll up or LASIK skincare, there's a million of these examples, right? Where the roll ups actually a lot of the synergies and value become in a unified back office, whatever. That's not that crazy for anyone these days, but is the brand, right? The value of the brand. And so I think the really complicated thing, especially for me to understand, where does that value really rear itself from a brand when you've got, again, in this example, you've got 10 fragmented brands and 10 markets. I mean, even in your case, which is very strategically focused regionally wise, real quickly, like Missouri, Kentucky, Tennessee, North Carolina, South Carolina, no deals yet, Georgia, Florida, Alabama, Mississippi, Arkansas, no deals yet. So you've got 10 states that you want to target with all of these companies in there. And do you see a thing that's like maybe what again to the sort of A1 unified brand or the any hour model where the brand becomes unified and all of a sudden it just becomes this regional unified powerhouse overnight? You know, the other examples, of course, are like Benjamin Franklin, 1 Hour, et cetera. A little different because those are franchises, but the brands are the same. But I would even argue, I don't know the economics behind those, but like those are really weird brands because some of those markets, they suck. They really do. They're terrible. On the marketing side, we see them pop up in different markets all of the time and they're terrible. They don't perform well. So local brand, as we talked about, can really have power versus again, the national brand, which I don't know. Has anyone ever pulled that off? Maybe Roto-Rooter, I guess, is probably the best example.
So let me try to unpack that. Where is value created by this combination? In fact, in our industry, it's not created by building a common brand. When I was in the security industry, we did rebrand everybody to our company. Honestly, investors don't care about that. That is not something that comes up in terms of valuing a business higher or lower, asking a question, is it one brand or many? So investors are fine with the many brand concept. And to some degree, it's those local brands where there's a lot of investment to build a reputation. A lot of these companies have been around for 5, 10, 15, 20, 30, 40 years sometimes. You alluded to this idea of kind of the back office. Think of the support staff required to support 10 individual $1 million businesses as opposed to one $10 million EBITDA business, right? Somebody in those businesses has to be worried about benefits and taxes and insurance and payroll and HR stuff and marketing stuff. And that's hard to do. It's distracting and it's really difficult to do when you have a 20 employee or 25 employee business. You have a 500,000 employee business, you can have someone who specializes in HR. So there are definitely some advantages from that perspective. The answer to your question about where does the value comes from, it comes from, you have to think about it from the perspective of the buyers. Prices are determined by supply and demand. For one thing, there are a lot of $1 million businesses out there. There's not that many $10 million businesses out there. So the supply of those businesses is lower, which drives up price. There's also more demand, or there's significant demand for those bigger businesses because there's a lot of investors, private equity companies and otherwise, that have a lot of cash they want to put to work. And it's much easier for them to buy a $10 million business than buy 10 $1 million businesses and go through all the transaction costs of doing that and then try to integrate them to put them on one financial system and one HR system and all benefits and all that. So it's kind of like you're doing the work for those bigger investors by buying a bunch of smaller companies, putting them together, and presenting a bigger integrated business to them that they can buy. So they put a much higher valuation on that than they would on 10 independent smaller businesses.
Well, that's a great clarification and a great answer for sure. I'm generally curious, is there a timeline for all of this? You alluded to it, your business plan, and Justin and Kristen talked about it. They talked about their plan from 0 to 10 million was I think it was a 5-year plan or something like that, maybe a 3-year plan. Is there a strategic, we want to be done with this, or complete? I'm not even sure what complete is in this context, but complete this by X time.
Yeah. So as you can imagine, when we first sat to put a business plan together, when you present something like that to an investor, you have to present to them a financial model that shows they're going to get a return,
Right.
right? You have to have some kind of horizon on it. We put a 5-year plan together. That's a reasonable time frame. It could show the value of what we were doing to potential investors. And you might say we have a 5-year plan that we built out when we started. The beauty again of our situation is we're not committed to an exit at a certain tick of the clock. So we're now 2.5 years in. We really like the way things are going. We see lots of runway. So we check in regularly with our investors and our team. If I had to guess a time, it's probably 3 to 5 years down the road that is likely to going to be our exit. But in 3 years, we might look at it and say, you know what, this is going great and we're creating a lot of value, and it's going to be a longer time frame.
I don't know how familiar you are with, there's a few people out there doing this and owning this, which is basically, I'll just call it anti-platform, anti-PE, right? Which is fine. And then there's people, even fewer, but there are people that are out there that are anti all of that and more into like ESOP, family succession, etc. As they say, this is what makes the world go round. Like everybody doesn't have to do the same thing, doesn't want to do the same things. But that said, in those models, there isn't this notion of taking some chips off the table, right? If you're at the contractor level, like owning the business and I want to divest, instead, I want to create value and wealth in other ways. Family succession might be one of those. There's a lot of those out there. There might be creating a platform, if you will. And I just want to point out, which you sort of alluded to, which I'm always curious about, because if you take some of the very big ones, Heartland, what's the other one down right in Kentucky? I just drew a blank. Turnpoint. There we go. Turnpoint. Woo, slow. Some of the really big ones, if you look at their portfolios, Turnpoint's a great example. They've been doing this for a really long time. They haven't sold anything. They haven't turned anything. And so the question sort of becomes is like, okay, well, I have no idea. I've never talked to anyone at Turnpoint in my life, but where are they going with this? And to your earlier point, do you get to a operational efficiency where your revenue and your margins, and in this case, your distributions for your investors and yourselves, are healthy enough where the strategy actually changes? Is that it? From my standpoint, again, for the record, never talked to anyone at Heartland, never talked to anyone at Turnpoint, but from the outside looking in, I have not seen any of their holdings go anywhere since I've been watching this stuff. I don't know that's even gonna happen. So I'm sort of curious, is that a possibility? Maybe the fine print of like plan C.
So a couple of thoughts. The larger entities that you referred to, there are some of those that have gotten so big, there's not really a universe of next private equity buyer.
Right, right. Which is a very great point. The only step there is maybe going public or something, right?
You might see that at some point when some of these bigger players view the public markets. I can assure you the bigger ones are thinking and looking at that all the time and plans on that. There's a lot of factors that go into making that call and moving in that direction. There really are no good comps for businesses like that that are public.
Right.
So it's challenging. I wouldn't be surprised at some point here, sometime in the future that we see that happen. To your other question about, do you ever get to the point where you just start running these businesses for income, basically? That just depends on the investor. So that is not something that will happen with us. Our investors, they're in this to grow this business. That's what they do. There are other investors that might be interested in putting cash into a business where they just expect to pull them out of. But we're a growth focused entity, so it's not likely to happen with us. I don't know that there's a lot that would pivot from growth to income in that manner. They may sell, there might be a buyer who sees these businesses as creating a lot of cash and just wants to buy it, not grow it, but just enjoy the cash that comes out of it. But this industry, there's a lot of focus on the value that can be created through that growth. That's where predominantly where the focus is for sure.
I don't want to put words into your mouth, but I'm betting and I'm guessing the fundamental strategy and your ICP, if you will, in terms of who you're looking for is where it's at. There is a large upside and there is large growth opportunities because when you're talking about a $500,000 to a $2 million EBITDA company in a lot of these markets, there's a lot of upside. There's a lot of places to grow and there's a lot of opportunity and some easy ones in terms of operational efficiencies, right? Those are the easy things. Growth through market share and brand are, I would argue, are some of the more complicated ones, right?
Very important, but not immediate. In some cases, some pretty short-term improvements that you can make that provide some of that growth. Pricing is a
Right.
good example, but there's also consolidating purchasing and field technology that can help be more productive with the leads that they get. So there's some kind of right away, some take 6 months. The growth and the just building market share, that obviously is a little bit more of a longer term.
Right. Well, that's an interesting one that I want to touch on too, because it's something that I know a lot of the smaller people struggle with. And again, in your ideal customer or acquiree, in this case, it struggles with too, the booking rates and the closing rates and your CSRs. So go back to, and if you don't know this, then that's fine. We'll go back to the numbers here of the 18 that you've done in the almost 3 years. How many of those had internal call centers or CSRs versus outsourced call centers?
None of them outsourced their call center other than after hours.
Okay.
They all had different levels of sophistication handling calls. So smaller businesses, it's one person who's handling the call from somebody having an issue or a question about service schedule to someone who has a breakdown and needs it fixed, to answer another call about a collection or another call about the electric bill for the building. You have someone who answers every call, and you can only be so good. It's a skill to develop to be a good customer service person, to be a good dispatcher. More sophisticated you get, the more you can segment those roles so you can invest and develop the expertise in those talents. The better you do at both managing your business, like from a dispatching standpoint, but significantly how good you do at taking the lead that you spend a lot of money on. Somebody who answers the phone, who's in the middle of 3 different things, who's got somebody yelling at them about where's my materials for this job, and somebody else that's banging on their door, that person's not going to do as productive a job with that call that you spent hundreds of dollars on as someone who is dedicated to that and focused on that and trained on that. So, that largely is by the size of the business, but that level of sophistication varies. And that's another area where there's a huge opportunity to create value by sharing ideas and helping each other out and learning from each other.
So that said, is that something that you leave at the entity level or do you unify that at the platform level?
We leave it at the entity level, do a lot of training and development. There may be a point where we decide there is some benefit to taking a different path there. Our first step, because there's so much an opportunity, is to just help all these businesses learn from each other and understand the importance of handling that lead correctly. A lot of that comes from data, right? So you have to track how many leads you have coming in, how many you get scheduled appointments. You want to follow average ticket sizes. You want to follow that process all the way through so you can compare productivity between different locations or in the same location over time so you can evaluate performance and improvements. But our focus is on keeping those resources in the locations, but helping to develop and build on their skill sets.
I think a lot of people would be curious to hear what are the resources or mechanisms that you all use on the training side for those people.
As I mentioned, I don't come from this industry. We hired a couple of very talented folks that have a lot of history in the industry that lead that training. We've used some outside training resources or evaluate some outside training resources. We continue to do that, but we have basically an internal team that supports each branch, and they visit branches, dive into the performance in that branch, evaluate how they're doing, come up with ideas to improve, and kind of facilitate those conversations and then help branches take those steps.
Gotcha. Just out of curiosity, does that sit under your operational level or?
Yep. So we have the way we're structured, we have regional operating vice presidents that basically handle 5 branches or 6 branches or so. But then we have other talented people that they can deploy to help in that process of improving each branch.
Gotcha. Gotcha. Basically, just a strategic call whether or not you wanted to outsource or insource that training role is what I'm hearing. And you decided to insource it.
We're integrating businesses all the time, right? So we have a new business that's joining us every couple of months. So that same group also helps kind of onboard the new business. And there's a lot of the same things you're doing in helping them transition to our systems and our data systems, our financial systems. So it's that same group that helps them first kind of integrate into our structure and then helps them to improve by comparing their performance to other locations and helping to identify areas that are worth focusing on to make some improvements.
Gotcha. Gotcha. You alluded to it. It pains us to see the businesses that have hired us effectively just fall or fail, if you will, or fall short of their goals because of these shortcomings. Just thinking about this today, when is the right time to invest in insource your CSR? I can just say the sooner the better, because especially if you're investing in marketing, I'll just disclose this. And maybe if you have any numbers that you're familiar with, you can share them. But from a booking rate in terms of external booking CSRs, meaning outsourced booking to insource booking, we'll see as low as 40% for sales qualified leads to all the way up to 85, 90% for sales qualified leads between, again, those outsourced call centers and those in-source call centers. The really sad part is that the people that need that booking rate, more important element of that booking rate, of course, are the smaller ones, right? Where the dollar of that lead has more impact. So you're effectively just throwing these lead dollars out the door, which is then your CAC, your customer acquisition cost, through the absolute roof. And we'll see, this number will blow you away. On the high end, high performing CSRs, call centers, mostly internal, will be the CAC cost from the marketing side of it can be as low as 250 to 280. Whereas some of the underperformers literally can't run their business like this. They'll be up to, in poor performing weeks, up to $800. We'll drop in and listen, read transcripts, and you just listen to this, and it's just painful. It is painful. People answer the phone that have no idea one single detail about the business, what service area they're in, what service areas they service, what services they provide. It's absolutely astounding. Again, the smaller businesses are just caught between a hard place where they're just like, well, I need the lead generation, but I can't overspend on my CSR, or I can't afford a CSR, or I can't even afford a fractional CSR. I said this, I don't know, maybe like a month ago or something. I said the difference between in-home services, those that grow and survive and those that don't, are the ones that invest in their call centers and CSRs early. Couldn't be more true.
You could not be more correct. The first focus needs to be, what are we doing? How good are we doing with the leads we're getting before you jump to how do we get more leads? There's a gold mine of opportunity and even modest improvements. If you have a low booking rate, if it's only 30% and you can move that to 40%, that's not that hard to do. You can spend a lot more money in marketing to get that 30% increase in bookings. Yeah, that's where the focus needs to be initially. And then when you're doing that well, then you need to be thinking about, how do I drive more leads and want to grow my business? But first things first, take care of the leads you're getting and make sure you're executing on them well.
This will be the last thing. From your standpoint as the acquirer, where do you guys start to focus on customer experience? Where is probably the answer is all the time, everywhere.
I would say this, it starts with our decisions on the right companies to have join us, right? We're very particular about the culture of the businesses we acquire. They don't have to be perfect businesses, but they have to have a strong culture around taking care of employees and taking care of customers. If you're doing that well, even if you're not pricing great, even if you're not doing a great job in your call center with leads, if you have that cultural foundation, that strength, you can fix those issues. If you don't have that right, it makes it really, really hard. It starts with finding the right companies to bring into our team. And then once you do that, it's a matter of, I think, recognizing and celebrating folks that do it well, making that visible and transparent to the rest of the organization so people can rally around great ideas and support each other as we continue to make progress down that path. And it's focusing on things like we've been talking about, like how is that customer experience when they pick up that phone and call us or go to our website. Takes a culture of high expectations and a culture of a team that's always striving to make that experience a better one for the customer. Do that well and you have that culture, you'll be on the right path. Then it's just a matter of step by step improving. It's building that culture and having a team that honors that is the really hard part.
I would agree with that. And this is anecdotal, but it speaks to that, the culture. And, you know, you've got to have people that want to be there and enjoy the industry. Then everything will fall into place. And the anecdotal part of this is I went to this like a week or two ago to the orthopedic and walked in, first appointment, first time I've ever been there. And it was unreal experience from the two people that greeted me until I finally got to the doctor, who's a friend of mine. So that was a pleasant experience. But there was not one person there that was like smiling or making my life easier. I probably will say something to this person at some point, but like it was just like, my goodness. I'm at the orthopedic, right? Like this is not life and death. Like this is a very like lifestyle, whatever thing. But the person helping me check in, to the person who helped collect my paperwork, to the radiologist check, and there were 4 people that touched me before the doctor. It was clear as day. They did not like their job. They did not like being there. It just like slapped me in the face. And I was just like, man, this is just tragic. It's just tragic for the brand, for the people, et cetera, et cetera.
Who wants to be in a job where you don't like being there? Do something else.
Yeah, I know. I was going to say that too. And someone once said to me, and I agree with you 100%. Someone once said to me, they're like, well, they don't have a choice. And I was like, they absolutely have a choice. You have a choice, whether you want to work for Costco and you want to be a greeter or a cashier or whatever, like that's your choice. And honestly, it looks like those people really enjoy their job and like what they're do versus this. It's like, if you're not happy, go do something else. Like there's no time like the present. So anyway, I digress. That was great. Really appreciate having you on. What's the best place to get in touch with you specifically if you have any questions?
Best way is Google Leap Partners, leapservicepartners.com. If you have a business in the Southeast, chances are you get a letter from me in the mail every once in a while because we mail pretty much every business owner in the Southeast. So you
Do
probably
you really? That's your lead gen?
very active.
How's that work for you?
It works great.
I mean, of the 18 or so, is that where the first touch is coming?
One of those was through a broker. The rest were self-generated through those letters. A lot of it through the owners that we've acquired that have people they know or people that reach out to them that they
Oh,
follow.
okay. A little bit of referral action.
We do a lot of mail. So if I'm filling your mailbox up, my apologies.
I don't think it's been released yet, but someone made a funny comment about home service businesses and they were sort of joking. They're like, if you've gotten a call from a 20 something year old or an email from a 20 something year old that's reading a script or whatever from one of these New York shop or something like that, that's not uncommon these days.
Ours come from me. They're a little more touch, a little more genuine. But yeah, you're right. Everybody gets those all the time.
We get them too. And you don't even have our services right, not replying to this. I can't imagine who has the data on that actually working. Anyway, well, cool. It was wonderful. Thank you for being here. And for everybody else, thanks for listening and go get them.